I think one of the biggest fears that a lot of people have about their money is trusting it to the wrong person. And I think that's a legitimate fear. I think there are a lot of advisors out there that are secretly salespeople, and it's not super clear when you're hiring them. And there are a lot of people on online forums that just say everyone should be a DIY investor and take care of their own finances. I'm not sure that's the answer either. So let's get into it. So today we're going to talk about a couple of different questions. One is, do you need a financial advisor? And the second one is, if you do need one, how do you pick a good one? So let's start with that first question. Do you even need a financial advisor? I had some strong opinions about this early on in my career, right after reading The Simple Path to Wealth by J.L. Collins. It was in that book that I learned that investing itself could be very simple, and it's really not that hard to manage your own investments, that I started thinking that financial advisors as a whole were maybe not necessary. But then I started working in the industry and kind of changed my mind a little bit. The biggest thing that I think I learned working in the industry is that there's nothing wrong with needing help on a specific topic. I think that managing your investments on your own, for example, is simple, but that's because I am a nerd who likes to read books about this. If I asked my wife if she wanted to manage investments on her own, she would say absolutely not. When I was working with the managed investing service team at TD Ameritrade and then Schwab, there was a framework that my manager kind of taught me early on in the process. He said our job wasn't to convince people that they should have managed portfolios or that they should stay in managed portfolios. It was just to talk about the pros and cons of different moves and help make sure that they were making the best decision for them. But he gave me this framework, which was that to manage investments yourself, you need to have the time to do it, the will or the desire to do it, and to have the skill or the expertise. So you need to have the time, the will, and the skill to be able to do it. And if you're missing any one of those pieces, the thought was it's better to outsource that to, say, an expert. And I think that framework can be helpful when you're making this decision too. You might have the free time and you might have the desire to do it, but you're lacking the skill. And if that's the case, keep watching these videos. I think we can get there together. But if you don't have the free time or you don't have the desire to do it, then yeah, you could spend time learning how to do it, but you don't want to do it anyway. So in that situation, it can be better to outsource it, right? That's part of where I softened on it. As I know that there are people who, if they don't have help, if they're trying to do it all themselves, they just won't get started at all. And I think it's better to get started and pay somebody for help if you have to, than to just sit on the sidelines and feel overwhelmed and never get started. So I want to start by kind of talking about some of the different types of advisors that are out there and kind of what problems they are solving for. And then you can decide if any of those are necessary for your particular situation. So financial planning involves kind of a number of different components, right? A lot of people just look at investments, but that's just part of it. You also have things like retirement planning, tax planning, estate planning. So you make sure that money goes where you want it to after you die. And you have risk management. So things like life insurance and health insurance and homeowners insurance. You have things like budgeting and debt management. And there's nothing wrong with needing help with any particular part of those. The problem that I see out in the industry a lot is that people will call themselves financial advisors or financial planners, but they're only doing one part of that, or maybe not even a whole part of it, right? So you might have people that say they're financial advisors, but they're just doing investment management. Or you might go to somebody who says they're a financial advisor, but really they're an insurance salesman. And they act like they're going through your whole financial situation, but really at the end, they're just recommending whole life insurance so that they can get a pretty big commission, you know? And I don't think there's necessarily a problem that there are specialists, right? Like for there to be an insurance specialist, I think that's great. Or a tax specialist, that's great. But there are two things. One is you have to make sure that you're going to the right kind of specialist for what you need. And you have to understand how they're being paid or how they're compensated. Because a lot of times things can get a little bit shady. We'll talk about some of those pitfalls and make sure that you avoid some common problems, right? So let's start with talking about insurance. I think it is unfortunate that there are a lot of firms out there that put people out there into the field as financial advisors. But if you look under the hood, they are commissioned salespeople. So they might talk to you surface level about budgeting and your overall financial picture. But at the end of that process, what they want to do is sell you an insurance product. Usually it's something like whole life insurance. The biggest problem I have with that kind of approach is that it's not usually very clear up front that that is what that professional is there to do. You think that they are there as an advisor to give you advice that is just in your best interest. And they might even think that they are. Based on their training, they might think that what they're offering is the best solution for you. Their training might be narrowly focused just on that type of product that they're trying to sell to you. And so you have that phenomenon where, to a hammer, every problem looks like a nail. To somebody who's selling insurance products, they might hear that somebody needs to save for long-term retirement, and the only solutions that they know about are insurance products. So that's how they will try to solve that problem, even if it's not the best option for the client. And like I said, the salesperson might not know that it's not the best option for them because they're just trained in that one field. But what if they did know that there were other options out there, that there might be investment tools, index funds, things like that, that might be a better fit for the client, but those products don't generate a big commission for the salesperson? Now, there might be some people out there who are selfless enough to recommend the low-cost index fund at their own personal expense by giving up that commission. But there's something about that incentive structure that I think creates an inherent conflict of interest, right? Where it incentivizes them to make certain recommendations because it's in their best interest as a salesperson, not necessarily your best interest. So I'm going to say this several times throughout this video, but I think the most important thing anytime you're looking at starting a relationship with a finance professional is to ask clarifying questions up front about how they are paid. You want to understand exactly how they're compensated for their work. And if they are paid commission based on sales of certain products, it's really important that you understand that up front and be pretty skeptical of any recommendations they make for those products. The second kind of advisor that I see really often in the financial world is investment managers. Once again, they might call themselves overall financial planners, but a lot of times they're just looking at your investment portfolio in specific accounts that you give them access to. And so they're not necessarily there to help you with budgeting and debt management and insurance and estate planning and all of those different things. They are there just to build a portfolio in a specific account for you. Now, like I said, that's not necessarily bad. I think a lot of people can manage investments on their own, but if you are one that won't get started without help, it's not necessarily bad to ask for help on this. But there are some common concerns that I would have. So I want to talk through those with you first. My first concern is just with their approach to investing. I've made several videos already about how I think that index fund investing is the best way to manage an investment portfolio. What I've said in other videos is that it removes some of the potential for human error as far as trying to guess what stocks will outperform. It makes it a portfolio that is self-cleansing, so you don't need to worry about particular investments going bankrupt or whether you need to buy or sell different things in your portfolio to maintain it. Index funds will build a passive portfolio for you that kind of tracks the overall market. One thing I haven't talked about so far on this channel very much is one of the big benefits of index funds is that they have very low fees. To contrast that, one of the biggest concerns about hiring a professional to be an investment manager for you is that typically they have pretty high fees. A lot of times it's around 1% of the portfolio value per year. That might not sound like very much, but if your portfolio is earning 8% per year, it's a pretty hefty chunk of your returns that goes straight to the advisor. Now, that fee might be fine if they have a reasonable approach to investment management, but you might be paying somebody 1% per year to try to be a stock picker or to try to actively manage a portfolio. They might be trying to time the market. And a lot of these things, the academic research shows it's very, very unlikely that a fund manager or a portfolio manager doing those actions will actually outperform the market. So you might be paying a recurring fee that's pretty expensive for somebody just to fiddle with your portfolio and actually underperform a portfolio of passive index funds. The more active they are, there might be higher trading costs like taxes. And the more active they are, the more likely it is that they'll make mistakes along the way and buy at the wrong time and sell at the wrong time or choose the wrong investments. And so not only are you paying that high fee, but you might be paying that high fee for underperformance or underperformance at a risk adjusted level, right? Like they might be taking more risk with your portfolio by trying to be active than what you would have taken on with a similar portfolio of passive index funds, right? Some of the worst that I've seen goes even one step further, where you're paying 1% for a portfolio manager, and that portfolio manager turns around and puts you into actively managed mutual funds. And some of those mutual funds are also charging 1% per year or some high fee like that. And so then your actual management fee isn't 1% per year, it's 2% per year. And like I said, if you're making 8% on your portfolio, that's a quarter of your annual returns. And that compounds over time. That adds up to be very expensive. And you would think that that would be fine, paying those higher fees, because you would think that a professional would be able to do it better than you could, and that they would be able to get a higher return on the portfolio to offset those fees. But like I said, that's not what the academic studies have shown. You can look at the SPIVA reports, and it shows that actively managed funds typically underperform, often by the amount of the fees that they charge. It's very difficult to know in advance what actively managed mutual funds are going to outperform their passive benchmarks after you consider fees. So like I said, there are just a lot of pitfalls to look out for as far as how high the fees are and the investment management approach of the person that you're hiring. If you're hiring somebody that has pretty low fees and they build a portfolio of index funds for you, they're just helping you build a diversified portfolio and manage risk, then I think that can be fantastic. It can be really beneficial having somebody to talk to. So if you see the market dropping, you can call them and talk through your fears instead of just doing it alone. But you just want to make sure that the fees are reasonable and that their approach to investing is reasonable. You don't want to pay somebody 1% per year for them to gamble with your money. And I think there is a potential for a conflict of interest that you should just be aware of with that kind of relationship as well. Imagine a scenario where you have them managing a pretty big portfolio in a brokerage account for you, and you go to them and ask them, would it be smart for me to make a pretty big withdrawal from that brokerage account to pay down some high interest debt that I have? Now, objectively, that might be the best solution for you if the debt that you have is charging a higher interest rate than what your investments are reasonably going to provide to you. That might be the right answer. But for that advisor, a big withdrawal from that brokerage account would also mean a cut in the advisory fees that they receive every year. Because like I said, it's based on percentage of assets under management for them. So there's a potential that they might tell you, no, keep your money invested because it works out better for them. I'm not saying every advisor is going to do that, but once again, just understanding the incentive structure of how different advisors get paid is really important for you to understand what potentials there are for conflicts of interest, just so that you can help navigate that and avoid it. If you need help specifically with investment management, we're going to have some videos that talk about different tools that you can use, because it is possible to get help choosing a portfolio with something like a robo-advisor, which would be like a digital platform that you fill out a questionnaire about your risk tolerance and your time horizon, and then it'll recommend a portfolio for you and manage it for you. There are some options like that that have a lot lower fees than paying an actual human advisor. And depending on the specific robo-advisor, I think a lot of them have pretty reasonable passive approach to investing. But there are also going to be other really low effort tools like target date retirement funds, different kind of like life cycle funds. So we will have a whole series of analyzing these different kind of semi-managed approaches to investing. So if you're not comfortable doing it all yourself, just be aware there are other tools you can use where you don't have to pay somebody 1 to 2% per year just for management. Now, the third kind of advisor that I want to talk about is the overall financial planner. This is the type of person usually who would have like a CFP designation, which is a certified financial planner. They're going to be the ones whose workflow involves the entire financial planning process. So if you meet with them and they are looking at your budgeting, your debt, your insurance, your estate plan, your investments, your retirement plan, that's a sign that you're working with somebody who's building a more comprehensive financial plan for you. And I think this kind of planner can be really beneficial. To be clear, this is what I'm going back to school to study, to step into that kind of role eventually. But there is still a potential problem, which is just that when you're hiring somebody to do a holistic, comprehensive financial plan like that, it's pretty expensive. It's a lot of work for the planner to do it properly. And so even though I think it can be a really valuable service, I don't think it's for everybody. Financial planners like that get paid a couple of different ways. One of them is for them to charge an assets under management fee like investment advisors do. And so a lot of times they will have investment management as part of the overall plan, and that is the part that ends up paying them. But there are other fee structures where you might just be paying a flat rate for a comprehensive plan, or you might be paying like an hourly rate. And I think that kind of fee structure can be really good because it helps avoid some of those other conflicts of interest. You're just paying for planning services. And so the planner doesn't have any reason to make one recommendation over another for you, other than the fact that they actually think it's in your best interest. Because for that type of advisor who is getting paid, an hourly rate or a flat rate, the best thing that they can do for you is to provide a plan that you think is really beneficial, because that's what will make you want to recommend that planner to your friends or to keep coming back for future plans, right? They don't really have any incentive to recommend one life insurance product over another if it's not the best fit for you. But since those comprehensive plans are expensive, it kind of makes it so that those planners have to self-select for only people who have a lot of money already for a couple of reasons. One is if they're doing the assets under management, getting paid based off of investment management, the bigger your portfolio balance, the more they get paid in commission from that, right? So they might have a minimum balance requirement of like $500,000 or $750,000 just so that maybe 1% fee that they charge is enough to actually cover the costs of them building those overall plans. And so they might not be there to help you if you've only got $25,000 or if you're just getting started. But even if they're not charging assets under management, if they're charging a flat rate, what if their financial plan costs $2,000 to build out in the first place? That might be, no problem at all if you're somebody who has $1 million portfolio and you're getting a lot of value from that financial plan. It might be totally worth it to you. But if you're just starting out and you have, a $2,000 emergency fund and that's all you've got, it doesn't make much sense for you to drop all of that on a financial plan. So there's this issue that I've noticed, which is that to get really good financial advice that is tailored to you, a lot of times you need to already have a lot of money. And if you're just starting out and you're trying to figure out how to get from here to the point where you have a lot of money, there's not really a lot of people there to help you along the way. To be completely honest, that's why I started this YouTube channel. I spent a while trying to do the math on how I could help people who are just getting started as a financial planner once I get out of college. And I ran into the problem of the economics that we just talked about, how either I would have to undervalue my time as a professional and not charge enough to justify the work that goes into a plan, or you can only work with people who already have a lot of money. But the other option is to do this, which is to put out education for free to help people in that first step of their life. And to be honest, I think it kind of works out because early on in your life, your financial situation is generally pretty simple. And taking just a few steps, putting a simple investment portfolio into a couple of basic retirement accounts and a brokerage account, building out an emergency fund, getting the right kind of life insurance, having a plan to pay down debt, and some very simple estate planning things like having a power of attorney and naming beneficiaries on accounts. Those simple steps can get you 95% of the way there. And also, financial plans are less accurate when they are 20, 30 years away. If you are 20 and you're building out a financial plan and you're trying to project your investment returns over the next 30 or 40 years, and your healthcare costs over the next 40 years, and inflation over the next 40 years, the kind of margin of error on those projections are going to be pretty huge. Whereas if you are 10 years away from retirement, you can start to get a lot more concrete with those numbers and start to make projections that are actually meaningful for you, right? I think there is something to be said for just building a simple financial plan that is good enough to get you started. And then you can hire a professional to refine that plan as you get a lot closer to the finish line. If you feel like you don't know where to get started at all, I'm hoping this channel becomes a place where you can learn enough about those fundamentals that you understand the pros and cons of different approaches. You understand those trade-offs. You understand why we're doing different parts of the process, and that understanding will make you feel confident in making those decisions and getting the process started. If you do have specific questions and you don't have an advisor to talk to, send me an email. I might not be able to give you specific advice on what you should do in your situation, but I can make videos talking about how I would think through it and talking about the pros and cons of different approaches and help you make that decision yourself. So I'll say again, don't hire an advisor just because you feel like you're supposed to. Only hire an advisor to solve specific problems for you. If you're just getting started and your financial situation is pretty simple, then have some faith that you can do it yourself. You can get the ball rolling. Investing and paying down debt and budgeting, all of these things on their own are pretty simple. And I'll have videos holding your hand through the process. We'll work on those fundamentals all together. But if you do meet with an advisor, remember to be really clear on how they get paid. Ask about their compensation structure. Ask if they get paid any sort of commission. And go in with open eyes about what that could mean for conflicts of interest or what you're paying for that advice. But in the meantime, I hope this helps you understand why I'm starting this channel. It's to help people who are in those beginning stages, who maybe don't have access to a comprehensive financial planner. And who knows, maybe by the time you actually need a financial plan, I'll be done with my degree and you can hire me then. But in the meantime, if you do have any specific questions, please send me an email. My email address is in the description underneath this video. I really would love to hear from you. I'm here to help you in any way I can. And I hope you have a great day.